All right, we're going to get started here now. And just for everybody's knowledge, we are recording this presentation, discussion, interview, and that has started today. So first, I'd like to welcome everybody to our class on life settlements and how they can help round out your portfolio and provide real diversity as you strive to complete your financial independence and/or build a family legacy. I'm really happy to introduce my good friend, Dr. Forrest Bryant. He's a financial advisor. I met him as the captain of the High Speed Alliance Mastermind. That's helped out a lot of my friends and professional acquaintances. And most importantly, he's one of the managers of the Brynes Capital Senior Life Settlement Fund. And he's got one for 2021. And in addition to Forrest, we have Chris Hines, who also is a co-manager of the fund, a CFP, and an attorney. So he wears a lot of hats and is actually very good in all of them. I asked these experts to share their information with us today because of a renewed interest in the alternative asset class of life settlements. As a Camel Plan tradition, we always try to use professionals that are in the business versus those who are just teaching the business. So we have just under an hour, and I have some questions we'll go through in an interview style, but feel free to ask any questions through the chat, and we'll try to get to all of them on the chat. We'll also provide contact information for you to reach out directly to these professionals with your particular questions for your own suitability, et cetera. As always, we do not endorse or recommend any investment, and we encourage everyone to seek expert professional assistance in any of their investment endeavors. This is strictly an educational event and is not meant to be selling. Please contact our guests directly for specific investment information. So at this point, I'd like to go through our disclosure. Let me see, come up there. There we go. I got to press it 3 times. So basically, as I just said, this is an educational event. Bring your professionals involved, even though Dr. Forrest and Chris Hines are professionals. You can use them off to the side, but bring in whoever you know and trust and want to be part of for that. If you have any questions on the self-directed portion of this, and if self-directed IRAs can be used in the fund or funds or assets like this, please contact Will Mucker at this information that we have here at this point in time. So I don't want to spend any more time on the introduction because Forrest and Chris have very good information, and I want to make sure we get through all of it. So Forrest, can you discuss, just to set us off on this, the volatility of the markets and the macro forces that makes this a good investment class today?
Yeah, sure. Thanks, Carl, for having us on. Have supremely enjoyed getting to know you over the last probably half a decade, I guess now, and just thank you for taking such great care of our clients. Camel Plan's been a huge supporter of ours, so thank you. Let me just kind of quickly just say hello. My name's Forrest Bryant. I'm the CEO of High Speed Alliance, and I'm also the co-manager of Brynes Capital with my good friend Chris Hines here. So, you know, day in and day out, we're working with clients who are mostly doctors and dentists and high net worth investors in the U.S., and we're helping them build out investment portfolios that take into consideration the macro economic and geopolitical forces that are going on, not only in the United States, but around the world. That may be a much deeper discussion than we can really get into here today. There's a lot of factors that many of you, if you lift your head up and look around a little bit, you'll see a lot of these things happening, with gross domestic product for the United States, and looking at inflation and looking at interest rates and looking at the money supply. There's a lot happening if you follow what's going on in the news. I think just to kind of boil it down to some things that I think you guys should be really focused on. One of those is inflation. I think if you are taking a look around, you probably have experienced inflation in your circle. So, Carl, I know a lot of the attendees that are on today may be small business owners. I think you've got a lot of real estate investors that are on here. So you don't have to look very far to see that inflation is an issue. The monthly inflation numbers are the highest that they've been since the 2008 global financial crisis. But on an average basis, we're going all the way back to 1990 for us to look at the inflation numbers that we've got currently going on. So you guys are seeing this on a daily basis as your materials cost, your labor costs, your used cars, your rent. There's just if you go to the grocery store, if you look at meat prices and dairy prices and grocery prices, almost everything that you're looking at, you're seeing price increase. And so some of that is due to supply demand and supply bottlenecks. And some of that is due to obviously the pandemic and everything that we went through last year with a decreased production in a lot of places. But one of the big things that you guys need to think about is how is it going to hedge against inflation that's going to continue to keep going up over time? So we're going to illustrate for you today that this investment that we're going to talk about does a really good job at hedging against inflation. Also does a really good job at hedging the risk in your portfolio. So we're going to get to more of that as we go along, but I hope that answers the question. Obviously, it's a broad one, and that's a very pointed answer, but feel free just at any time through the day today, please drop questions in the box there. We want this to be, we want to answer the questions that you guys have, but please drop those over there.
All right. Thanks, Forrest. That was very helpful. And I think a lot of people did realize the scarcity and the inflation that's there. And I know this isn't a selling event, but I want people to understand that you're actually working in this environment with this asset. Can you tell us just a little bit about Brynes Capital and the senior life settlement fund that you have now?
Yeah. So, it's important, I think, to understand a little bit of my personal background. In my first life, I was a dentist and went through a practice for almost 20 years and built a really nice business and sold it in 2015 to a private equity group. And through that experience, I started doing a lot of research. I'd always been a researcher in this space, but at that point, it got really serious about figuring out how the wealthy protect their money and how they continue to grow it. So I started going to a lot of family office events and started studying the family office space to learn how to invest my own capital. And through that time, I had a lot of my classmates and friends who said, will you help us? Will you show us, what you're doing and how you're doing it? And so that was really the birth of our investment advisory firm, which is FINRA registered RIA, which I guess this is probably a good time. Carl gave his disclosure at the front. Part of my business is providing investment advice and counsel and wealth building coaching for clients. And we are registered. We're state registered and with FINRA as well. So that is part of my job, is to help clients grow their wealth through certain investments. Many of those are on the alternative side. But if you're watching today, everything, this is impersonal advice. We're just talking in generalities. I will show some information that that we may tell some anecdotes and tell some stories about client success and that kind of thing, but make sure anything we say today, you run it by your particular advisors. But one of the things, Carl, that as I was studying to figure out where I wanted to invest my money, to look at what family offices were doing was, and I didn't even know what a life settlement was till probably 5 years ago, and came into this space and started learning about this. I knew, and I was a believer in using permanent life insurance as a portion of a well-balanced portfolio. Most of the family offices, almost, I would say probably 90 to 95% of family offices, and I'll use it, let me define family offices because that may be a new term to some of the people that are watching today. Family office is typically a super wealthy family. So you might think somebody with 50 million or $5 billion, if you had a big net worth like that, you typically wouldn't go to Wall Street and wouldn't go to Bank of America or Merrill Lynch and say, hey, here's a couple $100 million. Will you guys manage this for me? You wouldn't do that. Typically, what you would do is you would create a business around managing that money. So you would hire a chief investment officer, and you would hire a CPA, and you may hire a tax attorney. You would put together a team to manage that money. So that's kind of the background that we're looking at as far as investments. So whole life insurance or permanent life insurance is a very, very big piece of family office investing. So, and I was already doing that at that time. But then when I found out about the life settlement industry and that could also be an investment avenue for clients, that's when we really started looking at how do we invest in this and what are the investment opportunities? So not only was I looking for an investment for myself and for my clients, but that's how I got introduced to Chris. Chris is an expert in this space, and we'll probably mention Capstone as we go along here. But Capstone was the introducer for me to Chris, and they said you really got to meet Chris because you guys would really hit it off, and that actually ended up being true. But as I was looking for investment opportunities for myself and for my clients, I ran into Chris, and so I actually ended up investing in his previous fund, and a lot of our clients invested in his fund. And as I shared more information about the life settlement industry with clients, it became very evident that we needed that bond replacement piece for our clients. So we needed something that was very, very, very safe, but also had a good return profile. So as we were going through the options, there's really nothing else that comes close to life settlements as far as fitting that bill. So it fits such a big piece of the portfolio that Chris and I came together, and I said, Chris, we need to we need to figure something out here. So we kind of put our heads together, and that was really the birth of Brynes Capital, and putting this together and starting to build this out. And really, initially, we built this for our High Speed Alliance clients. This was custom tailored for them. And Chris and I realized that there were a lot of other accredited investors outside of our HSA clientele that could really benefit from this investment. So that's why we're here today. We wanted to share this information with your Camaplan people and let them know that most accredited investors just don't have access to this type of investment, and that's why we wanted to bring this to your community, Carl, just so that they would learn more about it and see if it might fit their portfolio needs.
No, I appreciate that. Education, has been one of the tent poles, that Camaplan's been brought on. So I really am glad that you and Chris could be here today for us. Thanks. So we haven't been talking much to Chris. So since he is all that smart, let's ask him the first real question I have. Can you explain to us what a life settlement is, just because some people may not know what it is, Chris?
Sure. I won't go into the background because Forrest really covered most of it. He did a great job. So I'm not going to spend much time next one. I know we got to get through some of the real substantive material for education purposes for your viewers here. So a life settlement is really simple. It's a purchase of a life insurance policy at a discount to its face amount. And another name for face amount is, I guess it's euphemistic, is a death benefit. So in this case, the investor actually becomes the owner of the policy. The investor is entitled to the contractual provisions of the policy, including the death benefit. he's also responsible for paying the premiums on that policy as well. So a total return on a life settlement investment is really the spread between the cost basis and the face amount of the policy. And the cost basis can include not only the acquisition cost of the policy, but also the amount of premiums that that investor is going to be obligated to pay until the policy matures. So it's really dissimilar to stocks, bonds, real estate, nice hedge, as Forrest mentioned before. I sort of, the closest approximation to it in the investment, sort of the more traditional investment world, is a zero coupon bond. So I sometimes will analogize it to a zero coupon bond with an indefinite maturity. So when we look at demand for policies, for example, demand for policies is really highest among those that are 70 years old or older, who have multiple comorbidities. Now, not to be confused with a viatical settlement. This is not a viatical settlement. These are not policies that we're purchasing on individual insureds who have a life expectancy of 6 months or less, but they do have comorbidities that sort of compromise life expectancy, and the investment is actually going to be based on a life expectancy calculation that I'll talk to you about a little bit later here, get into some detail. And the value of that investment is really premised on the difference between cost basis, death benefit, and then time to maturity. And of course, these life settlements, if you think about who's backing the life settlement, it's a pretty unique proposition where you actually have an instrument that's issued by some of the most financially sophisticated and sound companies in the world. I mean, you've seen all the names on the big buildings, the MetLifes, John Hancock's, et cetera. So these are the types of companies that have been around for hundreds of years. And you think about through thick and thin, where banks, I think there were 9,000 banks that went out of business during the Great Depression, and no insurance companies, to my knowledge, those that are part of the legal reserve life insurance system, went out of business. And in fact, a lot of those insurance companies bailed out the banks. So very stable investment, very plain vanilla, even though a lot of people aren't as familiar with it because it's really just a purchase at a discount to face value, and a great hedge because it's non-correlated to other sorts of instruments that some of our listeners may be and viewers may be invested in right now.
Hey, thanks, Chris.
You're welcome, Paul.
That was a good answer. And just to make it clear, when you say maturity, that's the death of the policyholder.
Yes, I'm trying to be delicate, Carl. So yes.
Well, yeah, that's not my strong suit, but you're the attorney.
Me neither, typically, but yes.
But so my question next is, why do policy holders sell?
All right, I think
why would somebody sell that?
Yeah, I'll take that one. So, it's important to think that, why would somebody buy a life insurance policy in the first place? And so a lot of times people buy life insurance to protect against a premature death, to take care of their family, to make sure that their family's needs are taken care of, or kids can go to college, or whatever you need. That's the most common reason that people would purchase it. But there's a lot of other reasons for life insurance as well. So a lot of I know we got a lot of business owners that are on the call today. So a lot of times there's a buy-sell agreement when you have multiple owners in a business in case something happens to one of the others, so that there's a smooth transition to the business. Also with estate planning needs, I know that's a hot topic right now. We'll try not to get too far over there, but with estate planning needs, a life insurance policy is put into place that could take care of or create an instant nest egg for the family that could take care of the family for many generations down the road. So a lot of times, and what we see very commonly is somebody who's a business owner, maybe they purchase this for estate planning or for business planning purposes, and maybe they've done really great, or maybe they've had an exit from the business, and the their net worth is to a position that they don't need the life insurance anymore for estate planning purposes, or maybe they've sold the business, or maybe they've sold their share. And so a lot of times these policies are sold for reasons that they're just not needed anymore, and they don't want them. There certainly are some cases where if somebody wanted to sell if they needed liquidity and they didn't want to continue making the payments on the life insurance contract, that they could certainly stop making those payments and they could get a lump sum, which is in excess. It's always important to kind of remember that this is it typically should be a win-win-win situation. So the policy owner can sometimes surrender the policy to the insurance company, and they can get a value for that, but that value is typically way less than what they can sell it for. So typically, and there are, we'll use the term aggregator right here, but there are aggregators, and you see some of these secondary and tertiary aggregators that you see some of the commercials on TV about selling your life insurance. And so a lot of those aggregators will kind of funnel up. And so, the companies that we deal with are not any of the ones that are advertising directly on the TV, but they all do kind of funnel up to some certain aggregators the policies are bought and then they can be resold sometimes. And then we at the fund level will go into and purchase those from a company that we trust very much, that we work with, which is called Capstone, which we'll get into a little bit. I hope that answered that question, that sometimes they just don't need it anymore, and they don't want to make the premiums anymore, so they can sell it. Or maybe there is a small percentage of people they just want the capital and they just want the cash out, and then get more cash by selling the policy than surrendering the policy back to the life insurance company.
Yeah, no, that makes sense. I mean, I've seen more commercials on TV lately, talking about that, and, the parents get older, they don't have income coming in, the kids don't need it anymore, they're out on their own. So I've seen that more and more on TV lately. So,
and Carl, can I make one more quick comment on that? The size
I can't stop you.
It's over a $30 billion market right now, and it's on its way to grow into $60 billion. So that's, it's a really, really big market. And so there are a lot of people that are selling, and they wouldn't sell if it wasn't a good deal for them. So that's one thing I think investors have to keep in mind. Nobody's getting taken advantage of here. This is something that they only sell if it's a good deal for them. So they have an interest to sell, and they're getting more money that they can get than by surrendering it. Sorry.
All right, no, that's good. Brings me up to my next question. How long have these life insurance settlements been around? And coupled with that, since I'm hearing so much about it, is this a new concept today in this environment?
Yeah, so I'll take that one.
Thanks,
Carl.
Chris.
So yeah, sure. So these have been around for about 110 years. There was actually a 1911 case that I think, everyone in the life insurance, life settlement industry is sort of memorized, but it was Chief Justice Holmes recognized life insurance as a property right in the case of Grigsby v. Russell. Grigsby was a doc. He had a patient. His name was John Burchard, and Burchard had purchased a life insurance policy. He made 2 premium payments. The third was overdue, and when he found out he needed surgery, he couldn't pay for the premium payment, couldn't pay for the surgery. So he sold his policy to Dr. Grigsby for $100, and the surgery ended up being successful. So it doesn't have sort of a, nefarious type of end to it. And Grigsby did provide the care up until the death of Burchard, and it was from causes unrelated to the surgery, as the story goes. But the case was brought by the family. Hey, look, he didn't have the right to sell the policy, and Holmes said no. It actually is a property right, and even though he didn't mention this, but even though we think about insurance as somebody who has an insurable interest, right? So if Forrest and I are business partners, I would have an insurable interest on his life. I have an insurable interest on my wife's life. She on mine. Kids as well too. So there is no insurable interest, but it was regarded as a property right. So it's been around for over 100 years. Now, obviously, since then, the industry has gone through quite a few machinations. I was introduced to the industry back in the early 2000s, and it was going through a really, what I'll call sort of a dark time, because they were focused on premium finance, and there was banks and investment banks in particular originating life insurance policies, just so they could make interest on money and use the policy as collateral and potentially sell the policy. And a lot of things happened back in the early 2000s that probably are beyond the scope of this discussion, but that gave the industry a bad name. And that was the impression that I initially had about the life settlement industry. So when I got approached to take a look at the Capstone portfolio, and Forrest had mentioned Capstone before, this is probably 7 years ago. I was very, very reluctant because of what I knew about the industry itself, and it just put a bad taste in my mouth. And it ended up that I after a lot of due diligence, and I was very, very surprised and very pleased at how these portfolios were constructed, and the opportunity that I had to be able to offer this sort of asset class and all the benefits of the asset class to clients. I've been doing this now for a little over 7 years. Forrest became a client, loved the asset class, and that's kind of where we came to be here. But this was something that, prior to, I'd say even, the year 2000, was really confined. This asset class was confined to very high net worth individuals or institutional investors. I mean, I found out that I guess Goldman Sachs had a life settlement desk. I didn't even know this asset class existed, but they had that quite a long time ago. So this is something that some of the key players in the space, of course, will talk to you about. They recognize the opportunity here, and it's become more and more popular, and the industry has certainly matured, as Forrest mentioned, grown to $30 billion or thereabouts, and it is expected to double in a very short period of time. So been around for over 100 years, well established, but certainly gone through some growth and really matured in recent history.
So who are the key players you mentioned there? Chris or Forrest,
Yeah, Forrest, do you want to?
Yeah, I'll jump in. I wanted to, I mentioned family offices before. I want to talk a little bit about endowment funds and just kind of who's in this all together. It's important to kind of look at the endowment model. In order to do that, I want to just kind of use a little example. So, let's use an example of a client that might have a $10 million in assets. So, if that investor was going to a traditional wealth planner or manager, they would probably, it's not unusual for them to have maybe 40% of their total portfolio into bonds. So, that would be, I use 10 million, that's easy math. So that'd be $4 million that investor may put into a bond portfolio. So we all know what's happening in bonds. The yields are, hovering a little bit above 1%. There's over or close to $17 trillion in negative yielding debt around the world. So, we think we're in a low interest rate environment, and we anticipate that that's going to continue to go forward for quite a while. Although the Fed is hinting that there may be some tapering coming up down the road, but it's going to be a while before those bond rates start to come up. So, using that as a little bit of a backdrop, the endowment model has changed tremendously, and I'll use the Yale endowment as they have the highest returns over the last several decades. They cream all the other Ivy Leagues. The Yale endowment model is one that we point to as is kind of the ideal endowment philosophy that we really subscribe to. And so really some of the changes, if we go back to like 1990, the largest holding for the Yale endowment was U.S. stocks, U.S. equities. So no surprise there. Probably 45% of the Yale endowment was in U.S. equities, and a very, very small percentage in life settlements. They actually use the term absolute return, which we love the absolute return. An absolute return means an investment that exactly what the return is going to be. And so our life settlement wealth fund is an absolute return. You'll know exactly what, if you put in a certain amount, you know exactly how much you get out. So the only thing that's unknown is the timing, which for reasons that we'll get into a little bit further, but you know what the amount of money that you're going to get there. So, but over time, the Yale Endowment Fund has the amount of U.S. equities has decreased from 45% to less than 5% currently. So they're very, very small percentage of U.S. equities. And the two areas that have really grown for the Yale Endowment Fund have been absolute return and life settlements, and also venture capital. So I love the philosophy, and it's one that we adopt for our clients, is what I call a barbell of using venture capital, which is high risk and also high return, and mirroring that with a life settlement portfolio or an absolute return portfolio. So basically with the life settlement portion, you've got bond-like risk and you've got an equity-like return, which is typically somewhere in the low to mid double digits on the life settlement fund. So that's part of the philosophy that the Yale Endowment Fund uses, and that now their percentages are pretty high. They're close to, both of them are about 23.5% to venture capital and 23.5% to absolute return. Now, that typically is not going to work for most of our clients. So we like the barbelling, but just to kind of make it real, like, what does that look like for a lot of our clients? That usually looks like about 5 to 10% of assets. So not making any recommendations, but just kind of giving you just kind of an overview of what that looks like. So, for the same high net worth investor that had $10 million in assets, instead of having $4 million in bonds with zero return, we're looking at maybe $500,000 to $1 million into senior life settlements. And so hopefully that helps a little bit. Don't want to get too long, but most of the big pension funds, most hedge funds, a lot of the hedge funds are rolling out of this because the time is a little bit longer. Most family offices, and there's some big major players here. Sorry, that was kind of long.
Yeah. Does Warren Buffett do any of this stuff, since everybody likes his name?
Chris, I'll let you take that one, because the answer is yes.
Okay.
Yeah.
That was simple.
He does. So, and it's funny because he was out of the market for a number of years and just came back in, I think in late 2019, kind of around the time that right before we found out about the pandemic. So no political statements here or anything. I'm just saying, Carl, coincidental.
No, I'm with you. So what's the best way to invest in a life settlement policy? Do people buy just one, or
yeah, I mean, you could buy an individual policy or a series of individual policies. Most of the accredited investors with whom Forrest and I work, what they'll do is, the cost of buying an individual policy, the risk of buying an individual policy is, in terms of lack of diversification, is probably a little too much to bear for the average accredited investor. So normally, how clients hold these policies is through the process of fractionalization, sort of like a syndication, right? So you buy a fraction, which is an interest in, say, a number of different policies, and you buy in with other investors, and the percentage of death benefit that you receive is directly attributable to the amount that you invest relative to the size of the overall portfolio. So that's really the best way that we found to have a fair amount of diversification, but without sort of over allocating, because Forrest just alluded to sort of a recommended allocation, even though we're not recommending it, and you certainly need to talk to your own advisor about it. But you want to have a certain percentage, but you don't want that percentage to be so high just in an effort to chase enough diversification. So the fractionalization is a great way to own these policies. I look at it as from an absolute return standpoint. The term I use is the deterministic model. So instead of probabilistic investing, which is, hey, well, we might get this rate of return, or this might be achieved, or we might get this payout later. It's deterministic. Another way of looking at absolute return, and that's what really makes this investment unique. Your annualized rate of return is going to be really based on time to maturity, time to death benefit payout, but you know exactly what you're getting from the get-go. So I like that deterministic type of approach, and we like the fractionalization approach rather than trying to purchase individual policies, unless of course you have a large enough portfolio such that you can achieve diversification by buying individual policies. But most of our clients, in fact, I don't think any of our clients do it that way. They use the fractionalization.
Well, let's talk about the risks of owning a life settlement then, since you brought that up.
Yeah, sure.
I mean, I'm assuming the first one is the person lives not forever, but longer than.
Yeah, we call that extended longevity. So I got face amount, extended longevity. I got all sorts of euphemisms for you today, Carl. So extended longevity would be somebody lives past life expectancy. But if we go back, let's just two general risks when it comes to life settlements and buying life settlements are time, right? So extended longevity, and illiquidity, right? Because the only liquidity that you'll have from a life settlement, at least the type of portfolio that that we're expert in, those portfolios are illiquid until there's a death benefit. So if you have assets where you might need liquidity in the near term, probably not the best assets to use to be buying fractionalized life settlement portfolios. When it comes to life expectancy and life expectancy calculation, LE is interesting, and I can tell you, for example, in our portfolios, what we look at is sort of and these life expectancy calculations, by the way, are done by independent firms. So the firms themselves are not part of, we want to have distance between us and the folks that are calculating these individual life expectancy assessments. And so the assessments are done, really, if you think about how it works in general, it's going to be, you get life expectancy, and then the life expectancy is going to have a series of debits and credits based on certain comorbidities or lifestyle of the individuals. And so when you're looking at, say, an average or a mean of 3 different life expectancy calculations, you're taking that mean number, that gives you an idea of what the LE is going to be. But statistically, LE is really just a 50-50 proposition. 50% of the folks pass away before LE. Again, broad statistics. 50% of the folks outlive LE. And when I say folks, I mean the insureds on these policies. So way to mitigate that risk is to be able to reserve premiums to life expectancy, okay, in a portfolio. So when you buy into a portfolio, you're going to be buying into the portfolio, paying a fraction of the acquisition price, right? But also reserving your portion of those premiums on all of the policies in that portfolio to life expectancy. There's also sort of an additional enhancement that we subscribe to, that we offer, which is we reserve life expectancy plus 2 years, and then the premium reserves for those dollars that come in when the investor purchases into the policy, those premium reserves are cash managed to try to get a rate of return such that those premium reserves can be extended even further. And we do that in conjunction with really good premium administration on the policies, and trying to ensure that the absolute minimum premium is paid to keep these policies in force, but not paying more than we have to, and being able to then cash manage those dollars to get a rate of return on those dollars. So that's the sort of the premium reserve management system, and how you can sort of mitigate the risk of extended longevity, almost self-insuring against that risk internally and transferring that risk to a third party in that regard.
Thanks, Chris. That brings up another question to me, and I guess all of the life settlement sellers have some criteria on how they select their policies. Can you give us a little bit of information on how you guys do it?
Sure. I'll take that for us. So on policy selection, we're choosing universal life insurance policies. So I know oftentimes on the sell side, I'll be talking to a client or an advisor, and their client may have a whole life insurance policy, and a whole life insurance policy, although it's a great policy, so I'm not disparaging the policy. Again, there's different policies for different objectives. But when it comes to life settlements, the life settlement purchasers are actually looking for universal life policies primarily. And the reason why is because there's flexibility of premium payments, more flexibility than any other type of policy when it comes to the universal life insurance policy. And that flexibility of premium payment and the ability to take cash and cash value in the life insurance policy and pay the premiums if there is cash value in the policy allows that administratively anyway, that premium management and that ability to pay that minimum premium. It really allows us to sort of optimize the premiums that are paid, preserve the reserves that we have to pay future premiums, and guard against the risk of extended longevity. So that's the right type of policy. So we start there. Then when we're building a portfolio, Forrest and I be relying on Capstone, and Capstone works in conjunction with a direct purchaser of life settlement policies, or life in the primary market or secondary market rather. Primary market would be clients purchasing those policies. But in the secondary market, that life insurance purchaser has done, I believe it's about $1.5 billion of purchases over the last 20 years. And so what they're looking for, it's a very exhaustive process that they go through. Everything is sort of fully medically underwritten. They look at big data. They do a lot of different background checks. There's a number of different forms need to be completed, and all the way from talking to the client about medical history, every other check you can imagine, but also looking at talking to the family and to make sure the family understands what's going on as well too, to prevent any sort of pushback, if any. I mean, it is an exhaustive process. By the time a policy reaches Forrest and I, and we're evaluating these policies and looking at which ones we'd want to accept into the portfolio and consulting with Capstone and trying to build a portfolio that makes sense, and looking at a life insurance policy that has gone through that underwriting process, that we've looked at the average, the mean LEs, and trying to sort of discern which policy is going to fit into our overall portfolio. And then when it comes to life expectancy, typically it's folks that are 70 years old or older that have at least 2 comorbidities, where the target premium on these policies is no greater than 5% of the death benefit. So there's a lot of metrics that go into this before a policy sort of hits our desk, and Forrest and I are kind of looking at it. I'm not certain in terms of the industry whether other portfolios are doing the amount of due diligence we are, but I can speak from a personal business standpoint, I suppose, that this is the type of due diligence that we do and that our partners do before we acquire a policy. So that's our overall policy selection process, and it is pretty exhaustive.
Yeah, just listening to you is exhausting me. But no, it's a lot of good information. But what's going through my mind is, I'm sure people are in different stages of their life and their financial situation. Some people may still be looking for income. Some may be trying to build a legacy. Is there an optimal way to incorporate life settlements into your overall investment portfolio?
Yeah, I'll take that one. That's a great question. And, I think it's important, and you hit on something there. Let me expand out on that a little bit. If you've got a long time horizon, and you're younger, if you're watching today, it really is a wealth building investment. This is something that with plenty of time, this can be phenomenal. And I'll go through a little example of what that actually could look like. But even in if you're in retirement or if you're pre-retirement, this is also a very good investment that can make sense for that point, just from the safety and the investment returns that can come from there. One thing I always kind of take a step back and look at, we mentioned life insurance, permanent life insurance as an example. And Chris alluded to this earlier. A lot of these companies have been around since the Civil War. I mean, think about that. I mean, that's almost 200 years. Some of these companies are 200 years old. And if you look at the return over like the last 100 years in permanent life insurance, depending on the company and the way, I mean, you're looking at probably 4 to 6% per year. And think about everything that's happened in the last 150 years. So, for an investor to look at an investment and go, well, if this is something that I'm committing to for a very long period of time, would you be comfortable with something that made 4, 5, or 6% per year, even in a year like the pandemic or the global financial crisis or the dot-com bust or, any of those things that it's just going to tick along every year? Life settlements is an investment that could actually have a double of that return that you can get from owning your own life insurance policy. So, I think there's a safety there and there's a short-term time horizon to it. But let me go through this example just quickly. And just as a reminder for those of you that are watching, we've got a kind of a gift slide deck that we're gonna send out and show. And this is one of the slides that's in there. We call it laddering a legacy. And really, what this really looks like is, if you invest into one of our, I'll use ours because I don't know anybody else that really does it the way that we do it. But, if you invest into a fund like ours that might have 8 to 10 policies in there, and you invest into that fund, over multiple cycles. And what a cycle would be is, if you got 8 to 10 policies, if all of those policies mature, you've got the ability to reinvest and to recompound that cash that comes out of each of those policy maturations. So, the way that this really looks like, where the rubber hits the road. So say there's 8 to 10 policies in there. There will be 8 to 10 lump sum checks that investor will receive over a certain period of time. And that time period could be 4 to 7 years, somewhere in that ballpark. So the investor has the option, when they get those checks back, to do whatever they want to with it. Yeah. And this is probably a good place to point out. You can invest into this with any type of capital. You can do this with cash. You can do this with any of your qualified funds. So if you have a Camel Plan account, if you have a SEP or a 401k or an IRA or a Roth IRA or an HSA, any of these types of self-directed accounts can invest here. And then ultimately, you can invest directly from a Roth, or there are some conversion strategies where you can invest into an IRA and then move that over to a Roth. And we may talk about that a little bit later. But the point that I want to make is, when you get those distributions, you can certainly take that money and do anything you want to with it, or you could reinvest it. So really, we designed this from day one to be a compounding investment, so that when those checks come back, you're going to be able to roll that into the next Brynes Capital Life Settlement Wealth Fund. And over a period of several cycles, so what we'd illustrated is taking a $100,000 investment. You've got an absolute return, and over about 4 to 5 cycles, which may be 20 to 25 years, that $100,000 investment will grow to over $1 million. And we can, and actually, I think that the math is really complicated when you're looking at hundreds and hundreds of policies that go in there. I think personally that's probably on the low side. I think it could actually be higher than that. But that is an example of, how do you build wealth? And how do you do that for your family? And how do you do that with the least amount of risk? I don't know of anything else out there that's going to allow you to have that kind of growth and have that kind of risk profile. So hopefully, that helps establish what compounding wealth could look like. But the other piece of that is, if you do that for a long time, it can also be a cash flow investment after you've been through several cycles. Those maturations and distributions could certainly come directly out to the investor at a certain point as well. So that gives you maximum flexibility. You can take the distributions, or you can reinvest it. And both of those options are there.
Hey, thanks, Forrest. I appreciate it. There's two things I'd like to do. I'd like Chris to share his screen if he can, showing where that information is so that if people have it, I mean, because what I just heard you say is if you're 20 years old, it might be one strategy, and if you're 75 years old, it might be another.
Yeah, Forrest, do you have that?
You guys see that?
Yeah, I can see that. So if anybody has questions, they can contact Chris here. And those slides that Chris and Forrest have talked about, you can go to that page, brynescapital.com/Camaplan, and get a set of slides that may give more information to you than what we've had. But the other thing that, and we can leave this up maybe, or you can take it down and we'll put it back up in a minute, because one of the other things I talked about, or that you just talked about, was the type of returns, 4 to 6 in one and double that in the other. Can you just give us a quick idea of what your returns you're seeing are in the past?
You want that one, Chris?
I think that might be you, Forrest. I don't know.
Okay.
Yeah.
Well, so let me take that. So, I want to take this back just for a second to why do endowment funds invest in this, and why do so many of them take a look at this? There are, we're not the only ones that do. Obviously, it's a huge market. It's a 30 billion growing to $60 billion market. There are a lot of institutions that put together life settlement packages. And so one thing that we found, looking for family office investments, is the more institutional something gets, the higher fees end up happening over there. So like the Yale endowment investments, the returns that they're getting are typically probably in the 6 to 8% range. And the reason that we can beat that is because we have a much lower cost profile for us to put this fund together. So our fees are actually way, way, way lower. And because of that, our investors and High Speed Alliance, and also those of you that are watching together, are get to benefit from having a lower cost structure, which equals it's investor focused. So that equals higher returns for you, the investor, than what even the Yale Endowment Fund can get into. So the way that we structure our funds, and I'll talk about ours, I can't talk about everybody else, but I would say I don't know anybody else that has the fee structure that we have or the returns that we have. But for our non-HSA clients, we have a preferred return for our HSA clients. But for those of you that are watching today, there's a 0.63 return, meaning for every $1 that's put in, there's 63 cents return. So what does that look like? For $100,000 investment, there's $63,000 in return. Now, so it's absolute. That's the return over a period of time. So going back to the example I used a minute ago, for a 4 to 6 year time period, $100,000 is going to equal $163,000, but that doesn't all come at one time. Basically, over that, you're going to get 8 to 10 irregular size checks. So what does that look like? Where's the rubber hit the road? If you put in $100,000, you may not get anything for 2 to 3 years. There might not be there's no cash flow. There may not be any distributions, and then you might get a $17,000 check. And then you may go another year, another 2 years, and then you might get a $22,000 check. So you're basically going to get 8 to 10 checks over that time period. And those checks are going to equal $163,000 for a $100,000 investment. So it's really hard to say exactly what the returns are because it's so time intensive. But, one thing that, I would say is, if it went way, way, way slower, so, even if it took 10 years, which, the good thing for us, as Chris outlined earlier, the investor doesn't have to pay the premiums past LE+2. So that's the biggest risk in the whole portfolio. We don't bear that burden. The investors don't bear that burden. We've got a fixed cost to the policy. We've got a fixed cost for the premiums that we will hold in escrow, and then beyond that, we don't have to pay that. So that's how we can give an absolute return on that. So the return is going to based on if you want to look at an IRR percentage, you're going to be looking somewhere in the mid-teens. So that could be as little as 12 and maybe as high as 17, but it really is time dependent and depends on some things that are out of our control. But we know it's an absolute return, and you know what that's going to look like. And I'll say one other just quick comment, because I see some questions in the chat box. We actually designed this so that it had a very low minimum investment. So it's a $25,000 minimum. So that was one thing that, we wanted to make that very accessible. And it's very lean on the fee structure. There's a one-time 2% fee. There's not an annual management fee. So it's just a one-time fee that you pay. And then the investors get 80% of the upside. So there's a 20% carried interest that's retained by by Brynes Capital. So it's very rich. For the investors, it's very transparent on the fees, and they know exactly what that looks like.
Yeah. And I appreciate that, Forrest. And people should, if you have those types of questions, get in contact directly with Chris or Forrest, because they can give you those details. We're trying to keep this educational, and what Forrest just told you was the way he does it. And every other fund has all different rules like that. But obviously he's familiar with what his fund does. Jeff also asked the question, I thought life insurance wasn't allowed in IRAs. And you're 100% sure you can't buy, as Forrest was talking there, you couldn't go out and buy a single policy in your IRA and put it into your account here at Camaplan. However, what you're doing is you're buying into a fund, and what you own is shares of a fund, and that fund owns life settlement policies, and it may own other things as well. But the fact is you're not owning the life insurance, you're owning shares in a fund. And that's why the IRS has allowed these so far to be able to be invested in as long as it's in a fund. So thanks a lot for talking about those returns. And I know we got to be careful with that and saying what a return has been and what it will be in the future. The SEC has a lot of rules on that. So just be careful when you're looking at this stuff. Get a professional in there, and don't believe any of the percentage returns that we talked about today. I'm only kidding you. So do we have, let me see, we're running out of time, but Chris, can you just touch on the Roth conversion strategy that Forrest did, and can you do it in a minute? And I guess if people have more questions on this, they can contact you directly. If you'll put up your slide right now, and let me read that.
Yeah, maybe Forrest can put up that slide while I give you my minute interpretation of it. So I'll keep it real high level, Carl, because I don't want to get into the specifics, because it may not be appropriate for everyone on the call. But in general, the type of portfolio that we've established, and the type of asset class you're dealing with here with life settlements, we're able to assist clients who are looking to potentially convert their IRA, their self-directed IRA, to a Roth IRA, and provide them with some advantages that are unique to this fund, and to the asset class in general, and what it takes, on the comparable sales side. So I'll leave it high level. If anyone individually has a question they want to follow up, obviously they can email me directly, and I'll have a specific conversation with that person. But I don't want to get too detailed in it, but just suffice to say that it is an asset class, and it is a fund that lends itself to an efficient conversion from IRA to Roth IRA. If clients are inclined to do that.
We got another question here, and it's kind of why are you better than other funds? You know, why Brynes Capital? If you can answer that quickly, that's great. Otherwise, you know, you can talk to him again. We'll put that slide up and get them to get contact.
I'll give you my 2 cents on it. I mean, one
Okay.
is the ability potentially, given the way the fund is constructed, to be able to do that efficient conversion from IRA to Roth, and that is unique. The other thing that's unique, it's not the asset class, because now the asset class has been available to, or has become available to a number of different investors, accredited investors. It's, I guess it's the way we hedge against one of the major risks, which is extended longevity through the premium reserve management system that I discussed earlier. And that's very, very important, being able to transfer that risk to, you know, really to a third party, and to construct a very thoughtful and effective plan of self-insurance in that regard.
Yeah,
Okay.
I'll echo that. If I can just throw in 2 cents here too. And, you know, I'd say, you know, obviously to what Chris said, the premium reserve management is specific to what we do. And also I would say, you know, it's probably a little bit different that, you know, this was actually designed, you know, I worked with Chris and we designed this. This is something that I wanted to invest in myself. I am personally an investor in this fund. So, you know, your capital comes in right besides ours too. And it was designed for our High Speed Alliance clients. So, you know, we designed it in a way where, you know, I wanted to do something that was going to grow with very little risk for my family and for my kids and for, you know, my future family. And, you know, it was designed that way. And, you know, Chris and I really thought through all of the nuances of this. And so, you know, you got an opportunity to invest right alongside us.
Just to quickly elaborate on that, our interests are aligned, you know, with those of the investor, right? Because we're going to, you know, primarily, I mean, we get a small fee up front. A lot of that is just, you know, poured back into the fund, obviously, in expenses. But, you know, we profit what you profit. You know, if we have good policy selection, we're in it for the long haul. And when you know, when you have that yield that pays, the policy matures, you know, that's when we get paid as well.
Okay, so let me just put this out. www.Brynes Capital, BRYNES Capital, CAPITAL.com/Camaplan. Okay, so to pick up your additional information, slides, contact that landing page or email Chris Hines at chhynes, CHYNES, at Brynes Capital, BRYNES CAPITAL.com, or call Chris on his phone, 508-751-5350. Chris Hines, 508-751. I forget the rest. He took it off.
Sorry, Carl. There you go.
That's all right. No, 5350. All right. Hey, I know you guys are busy, Chris and Forrest, and I very much appreciate you taking this time and educating our listeners. And we will post this up on our website, and you can have access to it as well. So I thank you very much for giving us your time and knowledge today. It was very, very much appreciated.
Thank you, Carl.
Very informative.
Thanks, Carl. Thanks for having us.
Yeah.
Thank you, guys.
Okay.
How do I end this?